Just a brief introduction of myself. I joined Nomura in '95, and since then I've been doing all Japan macro research for 20 years. From 2003 to 2008, I was based in London, where I covered U.S. and European investors, and I discussed lots of things regarding the Japanese macro and also Japanese yen. So I'm fairly sure I'm fairly good at replying to your very hard questions or sarcastic questions as well. Anyway, a little bit different from my side regarding the general risk sentiment. I have a fairly optimistic view in the global risk situation. The main two reasons why the market was so pessimistic until the early this year was the uncertainty related to the Chinese economy. I think now the situation is improving greatly, in particular after the Chinese government made it very clear to underpin the economic growth rate at least 6.5%, and also the kind of a market concern about the potential recession in the U.S. And the latest data set from the U.S. are clearly, I would say, denouncing the possibility of the U.S. slipping into recession. So I have a fairly optimistic view on the global economy and the financial situation. And from here, I'd like to address 5 key points related to the Japanese yen. First, why dollar weakened so much. Second, why yen strengthened so much. And third, anything very different in the Japanese institutions or flow picture, etc. So that's the third point. And the number 4 point is my outlook for the dollar yen related to policy responses from both the U.S. and Japan. And finally, in number 5 is the brief overview of the flow picture in Japan and the outlook for those important flows related to investment and also corporate related flows. So the first point is the dollar weakness. So as of the end of last year, beginning of this year, my forecast for the dollar yen by the end of this year was standing at 130. And surprisingly, however, there has been a very consistent weakness of the US dollar. But it's very important to break this dollar weakness period into 2 different phases. In January and February, it was general risk-off sentiment. So it was not a very big surprise for investors to set off chance of US rate hikes, and people bought Japanese yen. Japanese yen is still regarded as a safe haven currency. The second phase, in March, is a very different behavior in the FX market. This is a general sell-off of the US dollar. The key theme is the unsustainability of the dollar strengthening. People are really focused on the implication of the strong dollar on the US economy. And the people are really focused on the FOMC communication and also Janet Yellen's speech, etc. And they are really impacted by the dovishness of the Federal Reserve monetary policy stance. However, there are 2 very, I would say, important misunderstandings. Firstly, the dovishness of the FOMC is very artificial. I would say this is a politically demonstrated dovishness of the FOMC. I think the key trigger for this artificial dovishness was the Shanghai G20 meeting, in which I think Janet Yellen was asked to demonstrate her dovishness in FOMC and also her speech, etc. So overnight, we saw the latest FOMC minutes, which skipped the rate hike action. That's for March FOMC. And the reason why the FOMC lowered the expected rate hike path compared to the December policy setting meeting was the consideration of market concerns in global economics and also financial situation. So it's interesting that the FOMC is stressing the importance of market concerns, market participants' concerns, probably G20 nations' concerns about the global economic and financial situation. But I tend to think this dovishness is not necessarily coming from the U.S. policymakers' assessment of the U.S. economic situation or U.S. Inflation outlook, etc. Therefore, once the market situation stabilizes, I tend to think there is a very high chance of FOMC regaining back some hawkishness or willingness to normalize the interest rates going forward. So that's one thing. The other market misunderstanding is the impact of the strong dollar on the U.S. economy. So many commentators always write about, oh, U.S. economy is weakening because of the strong dollar, or ISM manufacturing recovered because of the decline in U.S. dollar, etc. But that's a very wrong observation. It's very true that there has been a very strong negative correlation between the value of the dollar and U.S. manufacturing index, for example, represented by the ISM manufacturing. But this is a very superficial, inverted correlation. The truth is, decline in oil prices has been the very, I would say, persistent headwind for the U.S. manufacturing activity. Therefore, if you have a look at the relationship between the decline in oil prices and weakness of the manufacturing indices, there has been a very strong correlation. The problem is, if you talk about the dollar value in a trade-weighted basis, the trade-weighted basis of the dollar value has a lot of Canadian dollar and the Mexican peso, who are extremely sensitive to the fluctuation of oil prices. So every time oil prices go down, there will be automatic boost to the dollar on a trade-weighted basis, because Canadian dollar will fall and the Mexican peso will fall in line with the decline in oil prices. Just for your information, 25% of trade-weighted basket of the dollar calculation is against Mexican peso and the Canadian dollar, those two oil-producing countries. So that's the reason why people are so, I would say, convinced that strong dollar cannot be sustainable, because strong dollar will slow the U.S. economy. Then the next rate hike will be impossible. That's kind of an argument. Okay, now I'd like to talk briefly about why yen strengthened in the first quarter of this year. This is basically because of, in my interpretation, the dissolution of Kuroda magic. So, until the end of last year, yen had never been bought by speculators. So if you have a look at, for example, Chicago future market, IMM kind of data, since the start of Abenomics back in October or November 2012, the spec positions had always been in short territory for the Japanese yen. And those spec players never tried to buy Japanese yen. But the situation completely flipped in December last year. The pivotal point was the announcement of the supplementary measures by the BOJ on 16th of December. There was a kind of a fine-tuning policy accommodation by the BOJ that sent a wrong message to the market. Market started to believe, oh, bazooka is not coming. And then people became, I would say, comfortable to start buying Japanese yen. Now, therefore, in the risk-off sentiment, Japanese yen is a typical currency to be bought by speculative players. So this is a reason why yen now has a tendency to strengthen as a reaction to risk-off sentiment. And also, when people want to sell dollar, Japanese yen is a good choice of currencies to buy. Okay, so I described what's going on in the speculative market in particular, but some commentators argue that now flow situation in Japan has changed from yen negative to yen positive. But I disagree with that idea. If you have a look at Japanese institutional money investing in foreign bonds, it is significantly accelerating rather than repatriating. So from the start of February, so basically after the announcement of the negative rate policy, the cumulative amount of Japanese institutional money investing in foreign bonds is as much as 10 trillion yen. Okay? 10 trillion yen, or 2% of GDP. So apparently, the flow is now accelerating towards outside of JGB, and more investment in foreign bonds, in particular U.S. bonds. However, as Yamada-san pointed out, there was no impact on the dollar yen. This is because of the hedging activity. They are uncertain about the yen depreciation trend, and general highly elevated level of the volatility is the reason why they love to attach currency hedges. However, this shift-out process will likely continue in the future. I'd like to point it out later. Number 4 point is policy responses. Okay. From April to July, this is a season for politics, both in the US and Japan, in particular in Japan. First, April FOMC. I'm fairly sure it will deliver a fairly hawkish message to the market. Overnight, we saw latest FOMC minutes. What was really surprising was the active discussion of whether to raise interest rates in April or not. It's very unusual for FOMC to discuss the future action rather than today's action. So that was pretty much indication of the FOMC's bias towards normalization of the monetary policy. And with regard to Japanese political action, first, we will have a BOJ meeting in April. Some people are skeptical about the BOJ's delivery of the additional easing because of the G20 agreement or G7 agreement, etc. But the matter of fact is, when the last time ECB delivered comprehensive easing measures, that was right after Shanghai G20 meeting. So I don't think the BOJ is now restricted by G20 agreement or something like that. Still, any G7, G20 country has freedom to do additional easing. Of course, currency intervention will be very, very difficult because any G7 nation will need to get approval from a counterparty nation. In Japan's case, that's the US. It will be very difficult until the dollar yen undercut below 105 or something like that. So far, I don't expect any currency intervention. However, additional easing should be quite possible in April. And in May, of course, G7 summit, Prime Minister Abe will host that summit. Therefore, for him, it will be an extremely ideal timing to show initiative by announcing fiscal measures, impressive fiscal measures, potentially including the further delay of the consumption tax hike, and then potentially the announcement of the double election in July. So this series of policy responses, BOJ, fiscal stimulus cancellation or delay of the VAT hike, and also snap election, this pretty much looks similar to the one we had in October to December 2014. So it may be a kind of a reacceleration of Abenomics to some extent, in my view. And if this will be combined with a fairly, I would say, optimistic assessment of the U.S. economy and the normalization of the U.S. monetary policy, the dollar yen will naturally start to reverse its course to the upside. That's how I look the dollar yen. And finally, the impact of the negative rate policy. It's already pushing Japanese money out from the JGB market for sure. As I touched upon, 10 trillion yen net investment since the announcement of the negative rate policy invested in foreign bonds. And as I see, private pensions, regional banks, and life insurance companies, basically all of them are investigating how to get out from the JGB market, in which yields are negative everywhere, up to 10 or 11-year JGB. And historically, there has been a very strong relationship between the level of the JGB long-term yield and Japan's investment in foreign assets. So, although so far it's FX hedged basis, but eventually cost of a hedge will rise because of the concentration to FX hedged foreign bonds investment. Then I think investors will gradually shift out towards unhedged investment in foreign assets as well. And all in all, if you assess two biggest fundamentals of the JPY, the one is the rate differential, the second is the flow fundamentals of the JPY. Both are suggestive of the sustained yen weakness. Therefore, the last element of the JPY, which is the speculative element and speculative players, when they start to reverse their, I would say, positions, the yen is a very likely currency to start weaken. And my forecast is 122 for the end of this year. Thank you.
Thank you, Mr. Ikeda.